So last class we had started with what is a financial market and what are the features of financial markets, correct? So today we'll be studying about the major classification of financial market. This is your section C question, classification of financial markets. So how many types of markets are there? Two. One is capital market and the other is money market. Under capital market we have two subdivisions called as primary market and secondary market. What does primary market deal with? It deals with new issue of shares. So first time when a private company is going public, that means you are open to borrow money from the public or public institutions, people, etc., then that is called as primary market. So first time you are offering your share market or subscription of shares from the public. Second, the point B is secondary market, where it is the market for existing issue of shares. So already you have bought shares from a certain companies and now you want to trade these shares of equity shares. Okay, you want to trade these shares, either the company shares, either you want to buy some more shares or you want to sell your existing shares. Then you will move to the secondary market, where stock exchanges, exclusively where companies are listed on the exchanges and only those companies listed are traded. Those companies' shares are traded. Commonly all of you have known as what? National Stock Exchange, NSE stands for, BSE stands for Bombay Stock Exchange. So therefore these are the two primary or major stock exchange in our country which deals with secondary market or existing issue market. The second part deals with money market. So the first part, capital market, deals with your long term capital, or I would say in short a fixed capital. Okay. On the other side, what does money market deal with? Money market deals with short term capital. Have you heard of the word working capital? Correct. What is working capital? It is the capital required for your day-to-day business activities. That means within one financial year. Correct. So the money where you raise your money for the meeting of short-term obligations is called as money market. Under that, we are going to study 7 different types of money market instruments. That is, first one, certificate of deposit, commercial paper, treasury bills, commercial bills, repo, reverse repo, intercorporate deposits. These are the 7 various instruments where companies or businesses, institutions, governments approach for short term capital or working capital. So all you need to remember is capital market deals with long term capital or fixed capital, and money market deals with working capital or short term capital. These are the two words that I want you to remember for capital and money market. Got it? Let's move to the first one today. What is a capital market? It is a market where buyers and sellers engage in trade of financial securities like bonds and stocks, etc. Now capital market, as I told, one thing you need to remember is it is a market where you can fetch money or funds which are used for long term in your company, like purchase of fixed assets, investment in technology. All this is long term. Okay, where you invest in 1 year but you reap the benefit more than one financial year, and that budget that you put for one time is a huge sum of money. The buying and selling is undertaken by participants such as individuals and institutions. Your second question arises is correct. First one is capital market is meant for long term or fixed capital. Second, who are the people who trade in this market? Those are individuals and institutions. So either individuals like you and me, right, can go and purchase the shares from the company, or even institutions can purchase shares of each other companies or businesses. Now, what is the use or what is the steps taken up by a company to go public? Okay. Now, let's say if you have seen around the shops wherever you're going out, right? Now, companies or businesses, they have XYZ Company Limited, XYZ Private Limited. Have you noticed the shop names? Now, next time when you're going out, please notice the shop names. Got it? Some would have kept it as limited, some would have kept it as private limited. Now, what is this difference is, when I say it is private limited, it means that that particular company does not borrow money or funds from the public. Understand? All the funds that is required by the company is raised privately, or it is raised by the members of the company itself. Got my point? That is called as private limited. When I say just limited, that means it is a public company. What do you mean by a public company? This company or this company's members are open to borrow funds from the public. They are inviting the public, irrespective they are an individual or they are an institution, to come and subscribe to their equity shares, in simple, to welcome their investment or their borrowings into their company. What is their return when they invest? What is the return the equity shares earn? Dividends, correct? So, dividends is to be paid for how much ever equity shares or the number of shares they subscribe from the company. So, what does capital market in short help us? Capital markets help channelize surplus funds from savers to institution, which then invest them into productive usage. So, our savings, when I am making sure I purchase 10 shares of XYZ company, basically I am putting in my savings into company. So, my savings will become capital for the company or investment for the company. You got my point? So, the company, like me, whoever has purchased 10 shares, like me, there are going to be so many people who are going to investing or subscribing to the company shares. Thus, they are going to create a huge capital or huge investment for the company. Now, what does the company do with this amount of capital or with this amount of investment is, they are going to convert this investment into productive usage. What is this productive usage? This company is going to use the money either for purchase of fixed assets or investment into technology, production of products, or rendering of services to people, etc. So, thus far, production of products or rendering of services means productive usage. So, by making business or by converting the investment into business activities, I am rendering a service to the public or society, or selling my products back to the public or society. And when the company is growing and earning profits because of the business activities, I am also contributing to the government in terms of paying taxes. You understood? One person saving, moving into investment or capital, and the company converting that capital into productive usage in the form of product or in the form of service, and then offering it to the public or the society, making profit and again giving it back to the government, respective government, in the form of taxes. So, this is how the entire capital market functions. Hope you have understood what is capital market, what does it trade in, who are the participants, and how is it turning into productive usage. And one more word, securities here. I want you to learn what are the securities they trade in capital market. Bonds and stocks. The first line, bonds and stocks. Now, what is a bond? Bond is a debenture where companies are going to borrow from individuals or institutions directly a huge sum of money. All of you would remember, whenever you are writing in your final accounts, 8% debenture, 10 lakh rupees. You remember writing that statement, right? Now, this 10 lakh rupees which you have borrowed, that is the company has borrowed from people, or institution, it is a credit, correct? So every time or every year the company, irrespective of the profits or losses the company face, it has to make a timely interest payment. On the other side, what is a stock? Stock is your equity shares. Stock is your equity shares. So equity shares is not termed as borrowing, but it is termed as a capital, correct? You write the heading whenever you are starting your balance sheet. Under liabilities, first thing you write is share capital. You remember that? Under liabilities in balance sheet, first thing you write is share capital. Under that first point that comes is equity share capital. So that is what the stock is dealing with. Understand? Now remember, for equity share capital, I am never mentioning the percentage of dividend I am going to pay. Have you observed that? For debentures, I write 8% debenture, 10% debenture. But have you observed, for equity share capital, I never write the percentage, but I write the lump sum amount like 50 lakh or 1 crore, etc. Equity share capital 1 crore. The reason why I am not mentioning the percentage over there is because equity shareholders are the owners of the company. They are the decision makers of the company. So after all the kinds of bills payment, okay, the leftover profits or earnings available to equity shareholders according to their contribution of capital. If I have purchased 10 shares, accordingly dividend I will earn. If I purchased 100 shares, accordingly dividend I will earn. In fact, if the company is going to earn super profits, that the entire super profits, whatever is left over after the bills, it will go according to the share they have made to the company. Understand? So therefore, the percentage is not fixed. It depends upon the profits that is left over after all the bills are paid. Whatever is left over, based on their contribution towards the company, they will be getting paid the dividend amount. Hope you have understood the concept, the overview of what is a capital market. Now let's see what does capital market consist of. First, it consists of primary market. What is the primary market? Where new securities are issued and sold. Notice that word, new securities. That means first time, for the very first time, if you just recall when I showed you the first slide, classification of financial markets, under primary market I wrote a 3-letter word called as IPO, which stands for initial public offering. So there the companies are going to first time issue or subscribe shares from the public. Point B, secondary market, where already issued securities are traded between the investors. So the most common capital markets are, I already explained to you, stock market and the bond market. Let's look at the IPO, initial public offering. What is it? IPO is the process by which a private company can go public. Notice that word, private company can become a public company. How? What is the procedure? By sale of its stocks to general public. It could be a new or a young company or an old company which decides to be listed on an exchange and hence goes public. Now every private company, when it is deciding to become a public company, that means it is ready to borrow capital from the public, it must follow up certain procedures or certain guidelines. Right, we have Companies Act of 1956. According to those rules and regulations, and also RBI regulations and also SEBI regulations, Securities Exchange Board of India. Okay. Now all these formalities and all the paperwork has to be completed by the companies, and only then when they get the approval from the registrar and from the SEBI, they can go public, or the company can borrow money from the public. Now, who can do that? It can be a new company. That means it is a startup company. It's just started. It's a young company. It's a budding company. Or it can be an old company. Old company meaning it has been a private company for the last 50 to 100 years. Understand? It's a well established company which is having a good business for the last 50 to 70 years. That means it's a old company, correct? So now it wants to go public. Now it wants to borrow money from the public. That is the meaning of old company. So once you have to go public, you also need to get registered your company name either in Bombay Stock Exchange or National Stock Exchange. So after IPO, that is after initial public offering. So let's say you are the company, you are the XYZ company, and you are ready to go public. You have completed all the formalities, all the paperwork, and then you have subscribed to the shares, and people have purchased your equity shares. Basically, they have invested money into your company. Done. So the people are coming directly to the company and purchasing the shares. When? Only in IPO. Please notice this difference. Under IPO, the public will approach the company, that is the issuing company, directly, then purchase the equity shares. Then once this process is completed, the subscription, everything is completed, after IPO, the company shares are traded in an open market. You understand? So first time when you as an investor are purchasing shares from the company, whatever the share price is quoted by the company, you have to pay that particular price and then purchase. And then after that, if you want to sell that particular share, then that shares will move to open market. That means it is traded in open market. Those shares can be further sold by investors through secondary market trading. So that will lead us to the second point called as stock exchange. Got it? What is a stock exchange? It is a secondary market. It is a market for existing issue of shares. It's not newly issued. Already you have purchased from a particular company directly, and now you want to sell that share or purchase any other company's shares, existing shares. Let's look at the meaning. A stock exchange facilitates stock brokers to trade company stocks and other securities. So what does stock exchange do? It facilitates exchange of stock. So either as an investor you can buy or sell the stock. A stock may be bought or sold only if it is listed on an exchange. We just refer to that point here, right? The company has to be listed on an exchange and hence goes public. So if a company, particular company, is not listed on BSE or not listed on NSE, then those company shares cannot be traded in secondary market. Only those companies names whose are registered and listed, only those shares will be traded. Now what are the two exchanges we are studying here? NSE and BSE, National Stock Exchange and Bombay Stock Exchange. These are the two top exchanges in India. When was NSE established? In the year 1992. It is the biggest stock exchange in India, while the Bombay Stock Exchange is the oldest stock exchange in India, which was established in the year 1875. Now all of us know this entire concept of stock exchange or trading of stock originated in Bombay or Mumbai. Got it? Now there it was established in 1875, and slowly it was all in the paper form. Correct? Thanks to technology today, but back then, before technology, once you sell the share, it would take more than 7 working days for the paperwork to be completed, I mean the legal formalities to be completed and the name to be changed, etc. Okay, it was taking a lot of time. But Due to technology today, as I told you already about the demat account, where it is only set up for purchase and sale of stock. What is set up? Demat account. Basically, it's called as dematerialization. So, I am going to avoid any kind of material or paperwork. Everything is electronic. It is the meaning of dematerialization. So, NSE began even much later than Bombay Stock Exchange, but by then technology was much improved or developed or improvised, and then it became more standardized format than the Bombay Stock Exchange. Although BSE is the oldest and the first stock exchange, today the leading or the most advanced technology used is the National Stock Exchange. So, today we have studied about classification of financial markets, what is the capital market, who are the people who deal in the capital market, what is the purpose of dealing, what are the securities dealt, and what is the outcome of investment. What does it consist of? Primary and secondary market. What is IPO? Initial public offering, and we studied what is stock exchange and what are the two famous stock exchanges in India.